All right, good morning, everyone. This is my personal Facebook page, not my business page, because apparently I don't have an established enough presence to stream a live video anymore on my Facebook business page. So, per usual, the smarter technology dumb the problems, and Facebook, aka Meta, it seems like every single chance they get to make an update that's supposedly supposed to make the app better, it just makes it worse. I don't know if anyone else agrees with me. I can't remember the last time they made an update where I was like, yes, this is so much better. Feels like every single update they make, it's like, what on earth are they trying to accomplish here? Other than sell more ads, so you have to click to 9 different locations rather than just one location to do the exact same thing, so they can sell the same ad 9 times. That's about the only thing I can imagine. So hopefully you made your way over here for my business page. If you were hoping to join me on my Facebook Live, I'm going to post that right now with my phone, letting anyone know that was hoping to join me. Again, I have no idea why. Apparently, I don't have an established enough presence to do a Facebook Live from my business page anymore, even though I've been doing them for quite a long time. But if you know more than I do and want to fill me in, that would be great. So, all right, let me see if I can. I'm just posting on my business page. Sorry, bear with me. Okay, so no one's on here. Not surprising. Completely random and new at this location. Hopefully, someone will join. In the meantime, go Gophers, right? So today is the beginning of the NCAA hockey tournament, which is the real bracket challenge, right? Let's be honest here. The NCAA basketball tournament, who cares about that other than millions of people? But for people like me who are much larger hockey fans than basketball fans, the hockey tournament is much more enjoyable to watch and follow. So they play Omaha, which is the 11th or 12th ranked team today at 7:30, and it's a Sioux Falls, South Dakota regional. The Gophers are 22-10-5, and I know we can always say this and we can dream all we want, but as a Gophers fan, three of the top, I think 6 or 7 people in the running for the Rookie of the Year candidates in the NHL were Gophers last year and could be Gophers this year. Brock Faber might win the Rookie of the Year, probably not. Connor Bedard will, but might. Logan Cooley up there and Matthew Nyes. They could all be Gophers this year as juniors, not even seniors, but they're in the NHL, almost winning Rookie of the Year. So imagine how good the Gophers would be if they sell those guys. But I'm sure every team could say that to some extent, but not quite that extent. So I digress. We are here to talk about money, not math, and because we're on my personal page, just a little education for those who are wondering. Weekly Money Not Math coffee talks are an informal way for me to have conversations and answer questions with people, even if they are not my clients, for free. You are welcome to join the Facebook Live or stop by my office for free coffee. I'm downtown Thief River Falls, and I'm always happy to share my coffee with good people over good conversation. There is no pressure to work with me or become my client by stopping by in person or online. It is my mission to provide the highest quality advice and service possible to my clients. Therefore, I limit myself to only having 100 or less active clients at all times that I have a fiduciary responsibility to. Even though I limit myself to only working with 100 clients at any given time, it is still important to me to provide as much value as I can to as many good people as possible, which is why these conversations are so important to me, and I plan on continuing to do them. Disclaimer, this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. I look forward to some great conversations and hope you have a wonderful day, whether you're watching this now, live, or at a later date. With that, are there any questions to start? Please put them in the comments section now or at any time during this video. I have 1 hour set aside on my calendar to answer questions, but if they're not enough to take up an hour, I'll likely wrap this up around 30 minutes because it's a lot more fun to answer your specific personal quick questions than it is to just read and talk at you guys. So please let me know what you're thinking, whether it's, obviously I prefer to talk about money because that's what we're here for, but I'll talk about pretty much anything. I love to have a good conversation. And I started the show with Go Gophers. So don't worry, I have a Gophers shirt underneath here if you are a Gophers fan. With that, I don't see any questions yet. So I'm going to highlight an article that I found on Morningstar.com, written by Christine Benz, and it is titled 5 Steps to Spring Cleaning Your Investment Portfolio. I will put that in the chat in case you want to read it yourself now or at a later time. All right, there's the comments. So portfolios can get unwieldy. Here's how to reduce some clutter. Oh, she goes in introducing herself. I'm not going to go through the whole introduction. All right, so she says, "Hi, I'm Christine Benz." Da 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 da. So first she says, I'll hit on the benefits of reducing the moving parts in your portfolio, of streamlining your portfolio. And I would throw those benefits into 2 key buckets. One would be financial investment considerations, and the other would be personal considerations. Then I'll get into 5 steps to take to streamline your portfolio. So we'll talk about reducing your number of investment providers as well as your number of investment accounts that you hold with these providers. Then we'll get into reducing the number of holdings, da 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 da. So first, I'm just going to highlight these points because I don't want to talk at you guys all day or read this entire article. But the key benefits of streamlining your portfolio, investment considerations. She says, now let's talk about the key benefits of streamlining your portfolio. The first major consideration relates to investment considerations. The basic idea is that if you do go through some streamlining, if you reduce your number of investment providers, your number of investment accounts, your number of investments within them, you'll simply have fewer moving parts to oversee. And that will simplify things from the standpoint of monitoring your asset allocation on an ongoing basis, figuring out where to rebalance your portfolio. So with that, we often encourage our clients to minimize their accounts, not minimize diversification. We definitely want to diversify worldwide when it comes to investing our portfolio, but try to minimize how many accounts we have in how many places, right? Because it can get very overwhelming. And it's very hard to track and have a very specific plan towards retirement planning if you don't even know what's going on and where it's happening. All right, so she says it also simplifies from the standpoint of reviewing that portfolio. If you have just maybe 10 or 12 holdings to monitor, that's simply a lot simpler than doing a full review process from a performance standpoint. Continuing on, key benefits of streamlining your portfolio, personal considerations. She says, then I would say that personal considerations are just as important. If you're saving yourself time in terms of oversight, in terms of performance monitoring and portfolio monitoring, that's just time that you'll have to spend on other things, which is a big consideration. And I completely agree. This is a big area where I know we're in the DIY generation where a lot of people are like, well, I'll just do it myself, right? Even our grandparents, they would be more likely to try to fix their vehicle before bringing it to a mechanic, where we're probably more likely to bring it in right away rather than try to fix it. But when it comes to financial planning, Etsy, and all these other things, people just love doing the things themselves. And I'm not saying you can't manage your own retirement planning, but what I often ask people is, do you really want to? Right? Let's say you're a doctor or a lawyer or a business owner or just any professional that works really hard all day. After working really hard all day to do your job or run your business, do you really want to go home and rather than spend quality time with your family or quality time relaxing, then try to figure out all this financial planning stuff? Or would it just be simpler and more time efficient to offload it to a professional that's all they do, right? So that's a big question to ask yourself. She says, step 1 is streamline your investment accounts. The first step in this process in terms of streamlining your portfolio is to take a hard look at all your investment providers as well as your investment accounts. So the advantages of doing so, again, get back to reducing oversight, reducing your record-keeping responsibilities. One is purely logistical, that you'll have fewer passwords and portals to have to keep track of. That gets to be a pain if you have a lot of different investment providers and a lot of different accounts. Keeping those passwords safe and making sure that you have access to them gets to be a bit of a different pain in the neck. So it's helpful to reduce the number of investment providers, and it simplifies tax season, as she said. So that's, again, whether you're doing it on your own, having less is easier, or just completely offloading it to someone else, less can still be easier. So second, how long can you go? The question is, how long can you go in terms of reducing the number of investment providers and the number of accounts? Well, in terms of investment providers, you can go quite low. You could go all the way down to 1, especially if you're retired. If you are talking about investment accounts, there's only so far you can go with this streamlining process, and the key reason is the tax code. That we all have multiple accounts that need to be kept distinct for tax reasons. If you have traditional tax-deferred accounts that consist of pre-tax dollars, that you've put in investment earnings, these are funds that you've never paid taxes on, so they need to be kept separate. And you might have Roth IRAs, which are after tax. Increasing younger investors have more dollar amounts in Roth accounts, but those Roth accounts need to remain distinct from your traditional tax deferred accounts. And then, if you're part of a married couple, well, those accounts that you each own in your own names for your own retirement, they need to remain distinct as well. So some of those retirement accounts have to remain distinct due to tax codes. So what she just said is, you could have all your accounts at one company, but have multiple accounts within the company. So it's still simpler, but not so confusing. All right, so she says you can still do a bit of cleanup. One of the key opportunities if you're looking to streamline is to look at all of the traditional tax-deferred accounts that you hold. And I mentioned that the typical worker has 12 jobs, so many people have leftover 401ks perhaps left behind at the old company, or they have rollover IRAs at various firms. These accounts together represent a major consolidation opportunity where oftentimes the best strategy from the standpoint of streamlining is to consider merging all of those accounts together into a single mega IRA. That's a new one. Mega IRA, basically just one IRA. And that makes it super simple to keep tabs on the account, which in many households is the largest account and allows you to silo that account with a single investment provider. So at the top of the list, I would take a look at all of the various traditional tax-deferred accounts. Make sure that you don't leave any behind because there are oftentimes smaller accounts that people forget. Really think back to your employment history and make sure that you're accounting for all of those traditional tax-deferred holdings or Roth or taxable, right? So this is a good one because it's amazing how often I have one client right now actually that we're rolling over one of their accounts and their account was literally just sitting in cash. So they had thousands of dollars sitting in this old account that they figured, it's in an IRA, it's fine. But what they didn't know is sitting in cash. So between now and 30 years from now, that account value is basically going to stay the same. Whereas if they had it invested, that could double once, if not twice, during that time period. So that's a massive opportunity cost just due to lack of organization. So it's really important to make sure you're aware of not only where your money's being held, but how it's being invested. All right, so point number 2, she says, consolidate Roth and taxable accounts with the same provider. You can do the same with Roth accounts. So she's just going to say everything she just said, but do it with Roth accounts. And I again agree. It's much easier to have things in one place. I'm skipping a lot of this because I don't want to read the whole article at you. But like I said, I did put it in the comments if you want to check it out. Step 2, embrace a simple portfolio strategy. The next step is to stick with a simple portfolio building blocks. So look through your portfolio and just make sure that you aren't using many holdings where 1 or 2 holdings would just do the job as well. On this slide, we've got the number of holdings in total market index funds, which are one of the best things you can do for your portfolio if you want to be a minimalist and want to reduce your ongoing oversight obligations. Index funds are very low cost. They provide a ton of diversification in a single shot. So the specific constituents will vary by investment provider. But the basic idea is that if you're buying a total market index, you are getting a lot of diversification. So she says in the Vanguard total market stock market, for example, there's 3,700 holdings. 8,500 holdings in the non-US portfolio, and roughly 18,000 holdings in Vanguard total bond market. So I often come back to index funds again and again when I'm talking to investor groups. The idea is I'm not sure when I'll see them again, so I want to recommend something they can hold for many years that won't cause them a lot of ongoing oversight. I think index funds are really it. So her main point there is you don't have to have 20 different funds you invest in to be diversified. You can pick a few, maybe 1, 2, 3, 4, or 5 that have a lot of holdings within them to be world diversified. And that makes things simpler. I oftentimes will see someone that they don't know what to do with their 401k allocation, so they just check every box. Well, if I put 10% in 10 different funds, I must be diversified, right? Well, 1, you're adding complexity, and 2, there's quite a bit of overlap, so you might not actually be improving your diversification or your efficiencies. So it's important to understand that sometimes we can just have a couple funds held, but within those funds there's a ton of holdings that diversify you. She says for larger accounts, see broad diversification. Consider multi-asset funds for smaller accounts. So she says if you have smaller accounts, an idea there is to use some sort of multi-asset fund. An example would be maybe you funded a Roth IRA while you were still working, but you never really got critical mass in that account. So it's still maybe sub $50,000 or something like that. You could use some sort of one-stop fund there. So she's basically saying the larger your account value, the more funds you should own, which I'm not sure I agree on that one. It kind of depends on the situation. And it's all relative to what's a lot to you. So she says, one part of this, she says sample minimalist in retirement portfolio tax sheltered. Then she talks about sample minimalist in retirement portfolio taxable. Then she talks about sample tax sheltered. So again, she's going through a ton of little things here that I don't think it's necessary for us to highlight everything today. But if you're interested, again, check it out in the link I included. Step 3, prune diversifiers and other clutter. So just try to decrease your clutter. Cash out high quality bonds, have diversified U.S. stock the best. To stream my holdings, consider cutting. She says step 4, if making changes, bear taxes in mind. This is really important. People get so caught up on what the rate of return of their account is, they often forget how taxes will affect their spendability factor, right? So, example, if you have $100,000, let's say $1 million in a Roth account after tax, it may seem like, hi Graceland, it might seem like you have so let's say you have $1 million in a traditional Roth IRA and $1 million in a Roth IRA. That's not the same value and it's not the same spendability because you have to pay taxes in the traditional IRA. Or, so that's one example of what the account value says is not always equal what you can actually spend. The other thing to consider when it comes to taxes is if you're doing a Roth conversion, so let's say you're taking some chunk of your tax deferred money in your IRA and converting it to after-tax money in your Roth IRA, you're going to have to pay taxes on that money that year. So it's important to understand what that's going to do when it stacks on top of the other taxable income that you have that year and how it's going to affect your Social Security income taxes and your Medicare taxes. Thanks, Graceland. Thank you for watching. She says, get some tax advice and watch out for capital gains tax. So the nice thing about capital gains tax is that there's 3 levels. There's 0%, 15%, and 20%, which is typically significantly lower than our income tax rate. So even though capital gains tax rates are paid annually when used, oftentimes they're actually less, which can be a good thing. She says, cut holdings in taxable accounts that have losses. That can help you off balance any taxable income you have. You may be able to tie in charitable gifts to decrease your tax that you owe. She says, step 5, document and stick with a once annual portfolio review. So I'm a big believer in annualized portfolio rebalancing, but it has to be scheduled so that we're not trying to time the market. If you're rebalancing because of what the market's doing, that's timing. If you're rebalancing based on what the media are saying, that's timing, right? So, but if you're rebalancing at the same time every year, that's not timing, that's just good practice, all right? So make sure you have a strategy in place that you're utilizing, and I would encourage you to lean on someone that you trust and that can give you a non-biased, non-emotional advice around your portfolio. With that, so that was a pretty long article. So if you have any questions on that article, please let me know what they are. If you have any questions on if you have any personal questions or financial questions you'd like me to discuss, I'd be happy to answer them. I love answering your personal questions a lot more than reading articles that I find online. Seeing none outside of the really cute comments from my daughter, thank you, and my wife, I will highlight another article quick, and hopefully that will conjure up some questions from the audience. And if it doesn't, that's okay too. Hopefully, no matter what, my main goal is to provide value, and that's why I'm here. So hopefully I'm at least doing that. The second article is from Morningstar as well. It's Morningstar Market Insights, Central Banks, Inflation, and Patient Investing, written by Dan Kemp. It says a look at key market and economic trends. Again, it looks like a relatively short article, so I'll read the whole thing. So Dan says, central banks were the focus of investors' attention last week. This was dated March 25th, so pretty recent. The Federal Reserve conformed with expectations, maintaining interest rates at their current level. In the accompanying press conference, Fed Chair Jerome Powell encouraged investors to expect 3 rate cuts this year, in line with current market expectations. So that's good news. 3 rate cuts. That means mortgage rates will probably go down and things like that. However, that could negatively decrease your return on your bonds. Keep in mind that. And we don't know when those rate cuts will happen. So we'll see. End of an era in Japan. He says, in contrast, the Bank of Japan ended its 8-year policy of negative interest rates. That's crazy. Can you imagine negative interest rates? This represents a significant policy shift and reflects the recent strength in the economy, higher inflation, and wage settlements. Japanese equities have benefited from this growth, with Morningstar's Japan index rising 47% over the last year. However, this return has been diluted for U.S. investors by the sharp fall in the Japanese yen relative to the U.S. dollar, providing a stark reminder that when investing overseas, we must take account of currency changes as well as the prospects for the companies in which we invest. Equity prices continue to rise. Despite a fall on Friday, U.S. equity prices rose over the week, with the Morningstar U.S. Market Index finishing 2.31% higher and 9.65% higher for the year to date. That's pretty fantastic, right? About 10% returns just so far this year. Now, the funny thing about that is the media is always trying to sell ads and they're always trying to terrify you. So for about 3-4 years now, almost every week I read an article that says, get out now. The market's at an all-time high. It's going to correct. It's almost a guaranteed thing. And yet we keep going up, right? We don't know when it's going to keep going up or when it's going down. The best thing to do is just have good fundamentals around investing and try your best to ignore the news. Unless you're listening to me, then I don't call myself news, hopefully. Hopefully some of the words I'm saying are valuable. A key contributor to this again was Nvidia, which rose 7.35% as investors reacted positively to its developer conference. All right, diversification means diversification. As United States asset prices continue to rise above Morningstar's analysts' estimate of fair value, it is natural to look for alternatives that appear more attractively priced. However, it is important to remember that the reason some investments appear attractive is that they are behaving differently from those that are rising quickly. While choosing more attractively priced assets can deliver higher returns and often appear smart in hindsight, such assets are likely to remain uncorrelated in the near term and create considerable regret as assets one has sold continue to rise in price, while those that have been bought languish or fall further. Such disappointment can lead to poor decisions. It is therefore vital that investors seeking better value holdings have the patience to overcome this regret and understand that market trends do not turn simply because one has changed one's mind. So that's basically, it's really important not to invest with your emotions. Whatever you're holding today, unless a planned rebalance is already in place, should probably be what you're holding tomorrow, regardless of what the media is saying and regardless of what the market's doing, right? So we can't react to short-term events when we have on our long-term plans. All right, inflation and Fed in the spotlight again this week. In a busy week of economic data, investors are likely to focus on personal consumption expenditure inflation data on Thursday. This is expected to show a slight fall in core PCE, which removes volatile food and energy prices, to 0.3% from 0.4%. Investors will also be listening for confirmatory remarks from the 5 Fed governors and chairs, including Powell, due to give speeches this week. Signs of growing concern about inflation would likely to have a negative impact on asset prices, which again is just conjecture. But inflation is never really a good thing. As we've all noticed over the last 4 years, even though the market's been up for the most part, and even though the economy's been strong for the most part, inflation still stinks. It makes everything that we were already doing more expensive. So it makes our raises that we get at work almost basically just break even, or maybe even fall behind. And it makes all the things we always love doing that much more expensive to keep doing. And it's really hard to stop doing something that you were already used to doing, right? So, and in retirement, people are conditioned to believe the number one risk to the retirement is market volatility, when in reality, the number one risk to your retirement is inflation, right? So, because if you just maintain the same income through your retirement, you're actually decreasing your lifestyle, all right? So, with that, I know we got started a little bit late, so I'll extend a little bit. I would love to stay until 9:30 if there are questions for me to answer, but if there aren't, I'll probably wrap it up here pretty soon, because I don't want to just talk at you guys all day. And I would love, as much as I would love to spend the whole day having chit-chatting and answering questions, I do have to get to other things to get done. So I'm going to pull up one last article. Again, I'm happy to stay until 9:30 if there are questions, but if there aren't, I'm probably going to wrap it up here after I finish this article. But first, I will include this article in the comments in case anyone would like to read it themselves. Oh, and how could I forget? I will also include the Gophers' schedule for those who are wondering, because obviously Gopher hockey is a very important thing to all of us here that are wondering about hockey or money and stuff like that. Hopefully they can win. I'm a little embarrassed to admit that I have them losing in the first round of my hockey bracket, but I would be happy to be pleasantly surprised on that one. All right, so last but not least, if I don't get enough questions to keep us on here, is cost of capital, a gut check on high-flying stock returns on dimensional.com, written by Marlena Lee, PhD Global Head of Investment Solutions, Wes Krill, PhD Senior Investment Director and Vice President of Dimensional. So these are pretty smart people, right? So it's a 3-minute read, pretty quick. I'll get through it. Again, I would love to get to the end of this article and have a bunch of questions to answer and stay until 9:30. But if I don't, I'll probably wrap it up here once I'm done with this article. So they say, nearly every year, a handful of securities generate headlines for delivering eye-popping returns. A challenge for investors is determining what portion of that return is a one-off windfall and not something to expect going forward. Viewing expected returns through the lens of cost of capital may help benchmark what constitutes a reasonable expected return from the market. Companies issue equity and debt, otherwise known as stocks and bonds, to raise capital for investing in and growing their business. Quick clarification for those who are wondering, when you own a stock in a company, you actually own part of that company. So when they make revenue, they often pay dividends to you. When you own a bond of a company, you're actually loaning that company money. So you don't own the company money. You don't own any of the company. The company owes you money, which is where you get a yield and things like that. So there's a slight difference there. I'm a firm believer that you get wealthy from owning, not loaning. But as banks have proven over a long period of time, you can make a lot of money loaning as well. So continuing with the article, the rate of return on capital invested in these securities depends on both the supply and the demand. The return must be sufficiently high to entice investor demand, but not so high as to discourage supply by the company, which could otherwise seek alternative sources of funding. The link between these forces means an investor's expected return is the company's expected cost of capital. This framework may help stave off FOMO, fear of missing out, about an extraordinary return event. For example, the Magnificent Seven stocks grew by 76% in 2023. Even if the concept of expected return is nebulous, does this seem like a reasonable cost of equity capital? How high would borrowing rates have to be for a business to issue stock at that expected return? If the Magnificent Seven companies can secure funding at a lower rate through other means, 76% is not their cost of capital, which means it is not an investor's expected return. So it's a big difference what they're trying to say here. They're saying it very in-depth. They're PhDs, right? They're really, really smart. What they're basically saying is, just because the Magnificent Seven returned 76% last year, that is not a reasonable expectation of return moving forward. Okay? We believe financial plans should focus on the expected return. You don't want to bank on the unexpected repeating. Long-term data is more informative than short-term returns in setting expectations for the future. Across a century of returns, the broad United States market has gained about 10% annualized, not 76. Academic research suggests that returns can be boosted even further by emphasizing stocks shown to have higher average returns in the market, such as those with smaller market caps, lower relative price, and higher profitability. Rather than trying to guess which stocks might provide next year's outsized returns or getting caught up in a cycle of fear and greed, we believe it is better to set reasonable long-term expectations to track progress through your financial goals. And I completely agree, which is why we leverage Dimensional for a lot of our custom-built portfolios for our clients. All right, so with that, why would community standards pop up? I'm not really sure. So with that, questions, comments, concerns, remarks, anyone? It is a beautiful day. The good news is it's cold right now in Thief River Falls, but it's supposed to get above freezing, so maybe the white stuff will disappear and we can golf soon. If there are any questions, I'd love to answer them. I'd love to stay on until 9:30. If there are not, I will probably wrap it up here shortly. This last article, I can't include a link, or maybe I can. I'll include the link, but I'm not sure you can actually access it because you have to have a Dimensional login to access it. But I can download it and send it to you if you're interested, so just let me know. All right. Okay, so I'm not seeing any questions. Again, hi Graceland. Thank you for being on here, and Brittany, and the cute comments. Always brings a smile to me. I'm going to wrap it up and wish everyone a great day. And hopefully by this time next week there is no snow on the ground. Thanks. Have a great day. Bye.